Now let's turn to two other assets that are typically found on many companies' balance sheets, including Starbucks. We're going to talk about goodwill and then intangible assets. They're similar, but there's a difference, and I'll talk you through those differences shortly. Okay, let's talk about goodwill. If an acquiring company actually purchases another company, we'll call that company a target company, for more than the fair value of its assets less liabilities, which we call net assets, then the difference between the purchase price and the fair value is recorded as goodwill. Now, it's considered an asset because the reason for paying more for another company's physical assets is because of the intangible value of the company. This could be things like its brand, its customer base, and intellectual capital, as well as its workforce. These factors are considered to be benefits that will last more than 1 year, which is why goodwill is recorded as a non-current asset. And the value of goodwill needs to be measured each year to determine if it's still appropriate. If not, it's written down to the amount considered to be a fair value. Now, let's contrast that with intangible assets. Now, similar to goodwill, intangible assets are assets that are used to generate revenue but have no physical substance. But here's a big difference. Goodwill has an indefinite life and cannot be sold separately from the business. The key distinction for intangible assets is they have a definite life, like say a patent that lasts 20 years, and they can be sold separately from the business. Okay, so examples of intangible assets that have finite lives and can be sold separate from the business are things like trademarks. So you think about the Coca-Cola trademark design or the Nike swoosh. It could also be patents or patents, however you want to pronounce that. It could be copyright. You can see in all those instances, we can sell patents separate from the business. We can sell copyright separate from the individual or the business. And that is the distinguishing feature. Now, because these trademarks have value to the organization, they're owned and cannot be used by others, they enhance the earning potential of the organization. They also are going to appear on the balance sheet in the non-current section. Now, different from goodwill, because these are definite life assets with a useful life, let's say of 5, 10, 20 years, we are going to amortize them like we do things like property, plant, and equipment. Now, if you want to learn more about goodwill and how to account for goodwill, you need to check out two of our courses. We have a course called Accounting for Business Combinations and Equity Investments, where we go into goodwill in a lot of detail. Next, you may want to take our M&A purchase price allocation course. It's a very advanced course where we go into goodwill calculations in a lot of detail. Okay, now let's head off to the next lesson. Now let's turn to a very common liability, and that is deferred revenue, also known as unearned revenue. And it arises whenever a company actually receives the cash for something it has not yet delivered. So think about airline tickets. We pay for our airline tickets in advance, and then the service, the flights, are delivered at a later date. Insurance is similar. We typically pay for our car insurance in advance for a year before it's delivered over those 12 months. Now, Starbucks also has deferred revenue, and as we touched on briefly, what is that deferred revenue? What is Starbucks selling to us up front without delivering the service? Well, that's gift cards, prepaid gift cards. Now, what happens with deferred revenue is, let's imagine a situation where I buy a $15 Starbucks gift card. I'm going to put the cash into my cash account, but I'm not going to record it as revenue. I'm not going to credit revenue. I'm going to credit deferred revenue, which is a liability. Now, for simplicity, let's just say on the next day, I buy a Starbucks coffee that costs $5. Well, the deferred revenue would drop from $15 to $10, and I'd record revenue of $5. The next day, I buy another Starbucks coffee. I get to record as revenue another $5, and deferred revenue drops from $10 now to $5. On the third and final day, I buy another coffee, and Starbucks records that last amount of revenue, that other $5, and my deferred revenue at the end of 3 days is sitting at $0. But then I buy another gift card, and the cycle begins again. Now let's turn to the equity section of the balance sheet. Under the shareholders' equity section or stockholders' equity section is where you're going to find the shares of the company. Now, equity, for the most part, is primarily made up of common shares. Typically, many companies don't even issue any other type of share, just common shares. There are other industries or companies that regularly offer both. So, for example, banking. In the banking industry, it's common for banks to issue two types of shares, both common and preferred. Now, let's talk about the benefits of common shares and the rights and benefits common shareholders have. First of all, common shareholders get to participate in the profits of the company after all debtors and preferred shareholders are paid. Now, how does this participation happen in practice? Well, it normally comes in the form of dividends. Now, common shareholders also get voting rights in a company. Common shareholders usually are allowed to cast one vote for every share held. And finally, if a company were to be dissolved, any residual amount after everyone else was paid would go to common shareholders. Now, let's contrast that with preferred shares or preferred stock. Preferred shares are different from common shares in the way that shareholders participate in the company. Usually, preferred shareholders are given a fixed dividend. However, this dividend may or may not be paid annually. If it's not paid annually, the preferred share dividend accumulates over time and must be paid out in full before common share dividends are paid. Finally, preferred shareholders will typically have no voting rights. We're staying in the equity section, and one thing that you often will see is authorized shares versus outstanding shares. What do we actually mean? And what's the difference between authorized shares and outstanding shares? Well, simply put, authorized shares are the total number of shares that a company has that it can sell. It doesn't mean it has sold them, but it can sell. Whereas outstanding shares are the total number of shares the company currently has outstanding. In other words, any shares that have been sold and have not been repurchased or retired by the company. Now, another common section in the equity section of a company's balance sheet is something called contributed surplus, additional paid-in capital, or simply paid-in capital. Now, a company may issue shares with something called a par value. And par value is simply the face value of the share at issuance and is usually a minor nominal amount. So this language comes when equity was sold as paper certificates. And so one share would be a certificate. And on that certificate, it was required that you have the name of the company, but also you had to put a currency value. So a par value for a share on that certificate might say $1, but then the company sells the share to the market at, let's say, $1.25. We need to split the amount that was received so that $1 goes to par value and the additional 25 cents goes into contributed surplus. Together, of course, we know how much the company received, which is $1.25. So let's look at a simple example of how this works in practice. So let's imagine a situation where a company issues 180,000 shares for 40 cents each. Okay, and that's going to work out to 72,000. Now, we're going to have to split that up because what we also know is the shares have a par value of 25 cents. So in other words, if there was a physical certificate, what would be printed on that certificate is 25 cents. The difference is going to be 15 cents. So let's do the math. We're going to put in paid up share capital, 180,000 times the par value of 25 cents, giving us 45,000. With the remaining 15 cents, we're going to put that in contributed surplus, and 180,000 times 15 cents works out to 27,000. Adding those two items together gives us the total of proceeds received by the company, which is the 72,000. Now that we've explored the concepts of authorized and outstanding shares, par value, and contributed surplus, let's see how it really looks in a set of financial statements. So let's look at Starbucks again. And here we have Starbucks, and we can see the common stock has a par value of, that's $0.001. So that's not 1 cent. That's 1/10 of a cent is the par value. And remember, the par value is like if there was a physical certificate, you would see 1/10 of a cent on there. Next, we see the authorized share capital, and that authorized share capital is 2,400, but remember, those are in millions. So that's really 2.4 billion shares authorized that Starbucks can issue, but it's only issued less than half of that at 1.1426 billion. Also, before we move on and look at other things in equity, like accumulated other comprehensive income and so on, notice that the additional paid-in capital, that's the same as contributed surplus. And you can see that given that the par value of a share is 1/10 of a cent, most of the proceeds that Starbucks received from selling shares would have gone into additional paid-in capital. Okay, now let's move on and we'll look at other items within shareholders' equity. Another section or account within the shareholders' equity section of a balance sheet is something called accumulated other comprehensive income, or AOCI for short. And this represents certain gains and losses a company may have that are not recorded through the income statement. Instead of being recorded through the income statement, these gains and losses go directly to the balance sheet through the accumulated other comprehensive income account. And we've highlighted that here. Now, some examples of typical items that might go through AOCI rather than through the income statement are things like unrealized gains and losses on hedging instruments or securities. Now, right below that, we've talked about now all of these: common stock, additional paid-in capital. We have a retained deficit, so that's retained losses, although it's getting better. The number's getting smaller, a smaller negative. We've talked about AOCI. There's one other line item that we need to talk to briefly, and it's called non-controlling interest. Now, some companies will recognize non-controlling interest on the balance sheet with a corresponding expense on the income statement. Now, we cover non-controlling interest in a lot more detail in our course, Accounting for Business Combinations. So if you're interested in learning more about non-controlling interest, please check out that course. Again, it's called Accounting for Business Combinations. Now, a critical part of reading a set of financial statements relates to the notes that accompany them. So here we have Starbucks notes. You can see there's an index. We're going to see that in the PDF shortly when we go back into the PDF, where we can actually see notes 1 through 17, which allows us to gain greater detail and insight into some of the items that are on the 3 primary financial statements. So for example, with the notes to the financial statements, we could figure out how inventory is recorded. Or, for example, what's included in deferred taxes. So there's note 14 on income taxes if we want to explore more around deferred taxes. The actual financial statements, the 3 primary financial statements, only tell part of the story. So in order to provide full disclosure, notes are provided to allow the reader of the financial statements to understand and make more informed judgments on the activities of the company. And for me personally, one of the most important financial statement notes is really the very first one, which is about significant accounting policies. This note presents important information, such as which accounting standards the company follows. How is inventory and how are investments valued? What type of financial instruments does the company have or utilize? How is revenue being recognized? How property, plant, and equipment is amortized, and any other policies that would help the reader or the analyst better understand the statements and the operations of the business. So let's go back to the balance sheet one last time and then start exploring some of the notes to the financial statements. So I am back on the table of contents. You're welcome to just click financial statements. I am going to go Control-Shift-N. Let me just get on here. Sorry, Control-Shift-N. And I'm going to go 47. And we get into the balance sheet. Now, if you've done the Accounting Fundamentals course and now done this course, you should be able to understand and explain virtually everything now on this balance sheet. So we have cash, short-term investments we talked about, receivables and inventories and prepaid expenses are in the Accounting Fundamentals course. We've talked about different types of investments, equity investments. We talked about property, plant, and equipment. We did an exercise on how to understand deferred income taxes. We talked about intangible assets. And goodwill. And then on the liability side, we focused on, for example, deferred revenue. A lot of the other items here are covered in the Accounting Fundamentals course, but what we did in more detail is really look at shareholders' equity and all those various line items. Okay, So now let us explore some of the notes. And I'm going to scroll down and we're going to see there's the statement of cash flows. We're going to come and look at that, and we're going to look at the income statement as well. But I want to get to this other table of contents page. This is your index for the notes. Notice that it's page 50 of the PDF, but page 47. Remember, there's a disconnect of 3 pages here. So if you want to do Control Shift and then the N, and you want to get back to this, just remember you're going to put in 50. And as I said already, one of the most important notes to spend some time on is the summary of significant accounting policies. So I clicked on that. Hopefully you found that too. And one of the things we want to talk about is, let's just scroll down and see what we can learn. So let's start with cash and cash equivalents. That's page 52 of the PDF. So what do they mean by cash equivalents? Well, they mean we consider all highly liquid instruments with maturities of 3 months or less at the time of purchase, as well as credit card receivables, to be cash equivalent. And again, there's a bit more detail. So again, we can make sure we know what's being included or what's being excluded. We then see in investments, but let's move down. Let's say we want to figure out how inventories are valued. Inventories are going to be quite big for a retailer like Starbucks. So I'm going to scroll up, and now I'm on page 54 of the PDF. It's page 51 on the printed page. And inventories are stated at the lower of cost, or net realizable value. And what that means is that, for example, if it cost us so much for coffee, but for some reason it got damaged and we have to sell it at a discount, we would then record inventory at that discounted amount. It's a conservative view. We're never going to bump it up. We're always going to do the lower of the two. Okay, so now let's look at property, plant, and equipment. And let's think about what type of depreciation they do and over what period. So here we have depreciation is computed using the straight line method over estimated useful life of the assets, generally ranging from 2 to 15 years for equipment and 30 to 40 years for buildings. So again, we can get a sense of how assets are depreciated or amortized as well. We can actually then go, and I want to know a bit more about property, plant, and equipment. So I'm going to go to another part of the notes, and we can see goodwill, there's intangibles. We could explore those in more detail. But what I want to do is I know what I'm going to do. I'm going to go Control Shift N, and I'm going to go to 50. And then what I want to do is there's inventories, for example. We could see what those inventories are. So let's click on that. We know how they're counted for, but now we can see their inventories are, let me close that so you can see that. The bulk of their inventories are unroasted coffee beans. Probably no surprise there. Roasted, other merchandise, that could be Starbucks mugs and things like that. So that makes up their inventories. No surprise that coffee was their largest single item in here. Okay, but now let's do the same thing. We're going to go Control Shift N 50. And let's look at some other things here. So for example, there's equity investments, other intangible assets, and goodwill. What I'm going to find here is I want supplemental information. So I'm going to actually go to note 7. And what we can see is a breakdown of their various categories of assets. So they have land, buildings, leasehold improvement, store equipment, roasting equipment, and so on. Their gross cost of their assets is 17,310. Remember, those are millions. So that's 17 billion, because these are in millions. And they've depreciated already roughly, well, more than half. You can see that accumulated depreciation. And this will match the number on the balance sheet. So again, as I keep saying, when you need more detail about that number on the balance sheet, it's typically found in the notes. Okay, and then for example, I'm going to go Control Shift N, go back to 50. And I want to know a bit about their financing. I want to know maybe a bit more about their line of credit. And you can see it says Note 9 debt, and it says page 60, I think it says 67, which is going to be 70 for us. I'm going to do Control Shift N and put 70. Let's see how close I get. Well, I'm pretty close. If I scroll down, let me just get my mouse working. Okay, here we go. Sorry, there we go. If I scroll down, you're going to see it does start at the very bottom with the revolving credit facility. more details about our short-term debt. And we can also see there are a wide range of bonds that have been issued. They're called notes. And we can see there are bonds that have been issued that don't actually reach maturity until up to 2050. So interesting, we can see these stated interest rates and their effective interest rates. So if we wanted, we can get a blended interest rate that we can use if we're modeling a forecast just based on doing a weighted average of these interest rates and the amounts outstanding. So again, we're going to send you now on a bit of a hunt to find additional insights into Starbucks by hunting through the notes and answering some questions. So good luck and see you in a couple of lessons.